Your money-making broadcast starts now. Good evening. Today is June 11th, Thursday. Here are the top stories moving the markets. We are witnessing a complete market paradox where a scorching hot PPI report was completely overshadowed by a collapse in oil prices, triggering a massive relief rally in tech and small caps. We will dive deep into why the stagflation narrative failed today and how Javas is positioning for the next move. Before we hit the big stories, let's look at the closing numbers. The S&P 500 finished at 7,394.30, up 0.83% from futures and 1.7% on the day. The Nasdaq surged to 27,171.20, a massive 3.38% gain led by the semiconductor bounce. The Dow Jones Industrial Average closed at 49,509.36, up 1.82%, showing broad-based strength. For small caps, the Russell 2000 was the star, with the IWM ETF climbing 2.96% to $290.41. In the fear gauge, the VIX dropped 12.51% to close at 19.44, confirming that the panic is fading. In other assets, WTI crude oil crashed 4.01% to $86.42, which was the real catalyst for today's rally. The 10-year Treasury yield eased down to 4.463%, and gold remains strong with GC futures at $4,237, suggesting that while we are rallying, some risk-off hedging is still in play. Bitcoin continues its volatile dance, but the focus today was firmly on the equity-oil correlation. Big Story 1, the PPI paradox and the oil signal. Let's get straight into the heart of today's action. The May Producer Price Index, or PPI, came in significantly hotter than expected. We saw a month-over-month increase of 1.1%, smashing the 0.7% forecast. Even more alarming, the year-over-year print hit 6.5%, the highest level we have seen since November 2022. Core PPI, which strips out the volatile food, energy, and trade services, rose 0.8% month-over-month, the largest jump since March 2022. On paper, this looks like a nightmare scenario, a confirmation of the stagflation fears that gripped the market after yesterday's CPI shock. However, the market's reaction was the exact opposite. The S&P 500 surged 1.7%, and the Nasdaq soared over 3%. Why? Because the market looked past the headline number to the driver. 80% of that PPI advance was driven by a massive 10.7% jump in final demand energy, with gasoline alone spiking 23.4%. Here is the Javas analysis. The market decided that this inflation is supply side, not demand side. When WTI crude oil collapsed by 4.01% to $86.42 today, the inflation threat was effectively neutralized in the eyes of traders. The logic is simple: if oil is falling, the energy-driven inflation spike is transitory. This is a classic example of second-level thinking. While the amateur trader sees a hot PPI and sells, the institutional player sees oil crashing and buys the dip. This narrative desensitization means the market has already priced in the worst-case inflation scenario, and any sign of oil stabilizing or falling is now a massive bullish catalyst. The VIX dropped 12.51% to 19.44, confirming that the feared decompression is real. For investors, this means we are moving from a state of panic to a state of opportunistic recovery, provided oil remains under pressure. Big Story 2, the semiconductor capitulation and tech recovery. Now, let's talk about the massive bounce we saw in the tech sector. The QQQ finished the day up 3.38%, led by a violent recovery in semiconductors. We saw AMD jump nearly 8% and Broadcom rise 3.62%. But the real story is the technical reversal. Yesterday, we witnessed a genuine capitulation signal, particularly with Nvidia seeing 8.44 times its normal volume on a sell-off. In the world of technical analysis, when you see a massive volume spike on a price drop, it often marks the exhaustion point where the last remaining bears finally give up. Today's rally was the textbook confirmation of that bottom. We saw a significant recovery in Qualcomm, which breached its stop at $191.20 only to rocket back up to $202.96, a gain of 6.15%. This tells us that the institutional support levels are still very much intact. Javas notes that the portfolio holdings recovered over $1,000 today, a 3.73% gain, validating the decision to hold through the volatility. The key takeaway here is that the AI trade is not dead, it was simply overextended and needed a sharp, volume-heavy shakeout to reset the base. As long as the 10-year Treasury yield continues to ease, and it did drop 8 basis points today to 4.463%, the high-growth tech sector will have the breathing room it needs to climb higher. We are seeing a shift from fear-based selling to value-based buying in the semi-space. Big Story 3, Labor Market Nuances and Macro Outlook. Finally, let's look at the broader economic picture, starting with the initial jobless claims. The numbers came in at 229,000, which is slightly above the expected 220,000. While this isn't a cause for immediate panic, there is a detail that Javas is monitoring closely: the 4-week moving average. It jumped from 215,000 to 219,000 in a single week. This represents an increase of over 4,000 claims per week on average. In a healthy labor market, this is noise. But in a fragile economy, this is a minority-class signal, a small warning light that could indicate the start of a softening trend. When you combine this with the May jobs report showing 172,000 added, we see a labor market that is cooling but not collapsing. This is actually the Goldilocks zone for the Federal Reserve. If the labor market softens just enough, it gives the Fed a reason to consider rate cuts without the economy falling into a deep recession. The bond market is already reflecting this, with the 10-year yield declining despite the hot PPI. This confirms that the bond market does not believe the Fed will be forced to hike rates further. The macro narrative has shifted from "will the Fed fight inflation with a recession" to "how quickly can the Fed pivot once the labor market shows a clear crack." For the next few days, the focus will remain on oil and the 4-week claims trend. If claims breach 240,000, we may see a shift in sentiment from a relief bounce to a growth scare. Now, let's examine the forward outlook after this pivotal session. The key variable going into tomorrow is oil. If WTI holds below 5, the disinflation narrative is confirmed and we could see SPY test 42 resistance, which was the June 9th close. If oil bounces back above 8, the entire relief trade unwinds. The second variable is VIX. It closed at 19.44, down 12.5%, but it needs to fall below 17 to signal the end of the bear regime. Third, we need to watch for follow-through volume. Today's bounce had conviction, but one day does not make a trend. The 2022 bear market had multiple plus 2% SPY days that were all sold into. My Java's framework says, maintain defense, let the bounce develop, and use any weakness to reassess the regime. Cash at 71.7% remains the optimal allocation for a bear D8 environment where VIX is still elevated above pre-crisis levels and PPI at 6.5% year-over-year is a structural inflation risk that hasn't gone away just because oil fell today. To wrap up today's session, the overarching theme is the triumph of price action over data. A hot PPI should have crashed the market, but falling oil and a technical capitulation in semis created a perfect storm for a relief rally. We are seeing the market reject the stagflation narrative in favor of a transitory energy spike theory. Now, let's get into the Javas recommended 4-stock lineup for the current regime. First, for a safe type play, the father of modern value investing, Benjamin Graham, would choose Vertex Pharmaceuticals, VRTX, at $452.10. The rationale here is the strong safety margin provided by their dominant position in cystic fibrosis and a robust pipeline of pain management drugs. With a low beta relative to the broader tech sector and consistent cash flow, this is a defensive fortress in a volatile market. For a balanced type approach, the legendary Wall Street manager Peter Lynch would choose Mercado Libre, MELI, at $1,845.30. This stock offers a perfect blend of growth and value, dominating the e-commerce and fintech landscape in Latin America. With revenue growth consistently in the double digits and expanding margins in their logistics arm, it provides the growth potential of a tech stock with the tangible asset backing of a retail giant. For the growth-type aggressive play, the world's leading innovation fund manager Kathy Wood would choose Palantir, PLTR, at $24.15. The driver here is the explosive adoption of their artificial intelligence platform, or AIP. Java's analysis shows a strong technical breakout pattern with RSI indicating strong momentum. The ability to monetize AI for both government and commercial sectors makes this a high-conviction play for the next era of computing. Finally, for a low-cost, contrarian play, the global investing master John Templeton would choose Alibaba BABA at $72.40. This is a classic reverse-thinking play. Despite the regulatory headwinds in China, the valuation is incredibly low relative to its free cash flow. With a low PE ratio and a massive war chest of cash, the downside is limited while the upside is significant if the Chinese economy stabilizes. This is a high margin of safety play for those who can stomach the geopolitical volatility. Before the close, here's the practical portfolio read-through for global viewers. The important point is not to chase every headline at the same speed. The market is giving investors 3 separate messages at once: liquidity is still supporting risk assets, leadership remains narrow enough to demand selectivity, and macro data can still change the rate cut narrative in a single session. That means the right response is a watchlist with rules, not a reflexive all-in trade. For conservative money, prioritize companies with visible cash flow, durable margins, and balance sheets that can handle a slower economy. For balanced investors, look for leaders that participate in upside but do not depend on a perfect macro backdrop. For growth investors, only add exposure when the revenue story is still improving and valuation is being supported by real earnings revisions. For lower cost ideas, focus on liquidity, catalysts, and downside discipline instead of simply buying the cheapest share price on the screen. The key risk into the next session is that a hot data point or a hawkish policy comment can quickly push yields higher and compress multiples. The key opportunity is that any confirmation of cooling inflation, steady employment, or resilient consumer spending can broaden participation beyond the same small group of megacap names. So the playbook is straightforward: keep cash available, avoid oversized single-name exposure, and use the first hour of trading to confirm whether price action agrees with the overnight narrative. One final discipline point: do not treat the closing price as the entire signal. Check whether volume confirmed the move, whether leadership held into the final hour, and whether futures support the same message before the next open. If those pieces line up, scale in gradually. If they diverge, patience is the trade. That keeps the plan flexible, measurable, and tied to evidence instead of emotion. Subscribe to stay ahead of the markets every single day. We break down the data so you don't have to. Check our shorts for a 60-second highlight. That's all for today. We all become wealthy together.